Namaste, and a warm welcome to all the bright young Indian engineers tuning in. You're at the cusp of an exciting journey, both professionally and financially. Many of you are starting your careers with excellent earning potential, but often the art of wealth creation isn't explicitly taught. This video is designed to empower you with actionable strategies to transform your small, consistent savings into substantial wealth over time. We'll demystify investing, help you navigate common financial challenges, and lay down a practical roadmap to achieve financial independence. Get ready to unlock your financial potential and build a robust future, one smart decision at a time. Let's begin this transformative journey together. Young Indian engineers often have a significant advantage, a stable career path, and typically above-average starting salaries. This provides a fantastic base for early investing. However, this phase also comes with its unique set of challenges. Many grapple with student loans, a major drain on early earnings. Then there's the lifestyle inflation trap. As income rises, so does spending, often preventing meaningful savings. And let's not forget peer pressure, the urge to keep up with friends' latest gadgets or travel plans, which can derail even the best financial intentions. Understanding these hurdles is the first step towards overcoming them and leveraging your inherent advantage.
Before you even think about investing, establishing a strong financial foundation is crucial. The first pillar is budgeting. It's not about restriction, but about conscious spending, tracking your income and expenses diligently. Second, build an emergency fund. Aim for at least 3 to 6 months' worth of living expenses in an easily accessible liquid account. This acts as a safety net for unexpected events. Finally, tackle debt strategically. Prioritize clearing high-interest debts like credit balances or personal loans, as their interest can erode your wealth faster than any investment can build it. These 3 pillars will give you peace of mind and a solid platform for future growth. This is where the magic truly begins, the power of compounding. Albert Einstein famously called it the 8th wonder of the world. Simply put, it's earning interest on your interest. The earlier you start investing, and the more consistently you do it, the more time your money has to grow exponentially. Consider this powerful example. If you invest just 5,000 rupees every month, consistently for 30 years, assuming a modest average annual return of 12%, you could accumulate a staggering 1.75 crore. Your initial investment would be 18 lakhs, but the rest, over 1.5 crore, is pure compound interest. Time is your biggest ally here.
Diversification is the golden rule of investing. Don't put all your eggs in one basket. For young engineers, a mix of asset classes is ideal. Equity, through stocks or mutual funds, offers high growth potential, but comes with higher risk. Debt instruments like bonds or fixed deposits provide stability and lower risk, though with typically lower returns. Consider a small allocation to gold as a hedge against inflation and economic uncertainty. For the long term, real estate can be a wealth builder, though it requires significant capital and careful research. The key is to create an asset allocation strategy that aligns with your risk tolerance and financial goals, ensuring a balanced portfolio. Understanding the relationship between risk and return is fundamental. Generally, higher potential returns come with higher risk, and vice versa. As young investors, you have the advantage of time, which means you can afford to take a calculated, slightly higher risk for potentially greater long-term returns. However, your risk tolerance should always be aligned with your financial goals and personal comfort level. Are you comfortable with market volatility for greater growth, or do you prefer a more stable, albeit slower, accumulation of wealth? Diversifying your portfolio effectively helps to mitigate specific risks without necessarily sacrificing overall returns. Evaluate your risk profile honestly. Now, let's talk about specific avenues. For most young engineers, systematic investment plans, SIPs, and mutual funds are an excellent starting point. They allow you to invest a fixed amount regularly into equity or debt funds, benefiting from rupee cost averaging. For those with a keen interest and time for research, direct equity investing can be rewarding, but it requires significant due diligence. Don't forget long-term tax-efficient options like the Public Provident Fund, PPF, and the National Pension System, NPS, especially for retirement planning. A crucial tip: automate your investments.
Set up auto debits to ensure consistency and remove the emotional aspect from investing.
You have the knowledge, now it's time for action. The most important takeaway is to start now, no matter how small the amount, and be consistent. Financial education is an ongoing journey. Continuously educate yourself about market trends and new investment opportunities. Remember to review and adjust your portfolio regularly to ensure it still aligns with your evolving goals and risk appetite. And don't hesitate to seek professional financial advice when needed. A qualified advisor can provide personalized guidance. Your journey to financial freedom as a young Indian engineer starts today. Take control, make smart choices, and watch your small savings transform into big wealth. Jai Hind.